SES/crypto investing, financial markets, capital protection /CME group, bear call spread minimum profit. A bear call spread involves two legs. 1. Selling, writing, and out of the money, OTM. Call option. You sell a call option with a strike price above the current market price of the underlying cryptocurrency. This generates premium income. 2. Buying a higher strike OTM. Call option. Simultaneously, you buy a call option with the same expiration date but a higher strike price than the one you sold. This leg acts as a protection or hedge to limit your potential losses if the cryptocurrency's price unexpectedly rises significantly. The net effect is that you receive a credit, the premium from the sold call minus the premium paid for the bought call. This net credit is your maximum potential profit. Step-by-step process for a bear call spread. Aiming for maximum profit. 1. Market analysis and cryptocurrency selection. Identify a cryptocurrency. Choose a cryptocurrency you believe will either stay flat or experience a moderate decline in price over your chosen timeframe. Avoid cryptocurrencies with strong bullish momentum unless you have a very specific technical reason to believe in a short-term pullback. Technical and fundamental analysis. Resistance levels. Look for resistance levels where the price has struggled to break above in the past. Your sold call strike should ideally be at or just above a strong resistance level. Overbought conditions. Consider if the cryptocurrency is currently overbought according to indicators, e.g., RSI. News and events. Be aware of any upcoming news or events that could significantly impact the cryptocurrency's price. Avoid trading around major announcements unless you are highly confident in your directional bias. Implied volatility. 4. Bear call spreads generally benefit from higher implied volatility at entry, as this inflates option premiums, increasing the credit you receive. However, a significant drop in IV during the trade can also be beneficial, as it decreases the value of both options, especially your short call. 2. Choosing strike prices and expiration date. Expiration date. Shorter term. Bear call spreads often benefit from shorter term expirations, e.g., weekly or monthly, because time decay, theta, is faster, meaning the options lose value more quickly, which is favorable for a credit spread. Time horizon. Align the expiration date with your expected time frame for the cryptocurrency to stay below your sold strike. Sold call strike, lower strike. Out of the money. OTM. This is crucial. You want the sold call to expire worthless. Choose a strike price that you are confident the cryptocurrency will not reach or exceed by expiration. It should be OTM and ideally just above a resistance level. Premium. The closer the strike price is to the current market price, but still OTM, the higher the premium you will receive. This directly impacts your maximum profit. Bought call strike, higher strike. Higher strike than sold call. This call must have a higher strike price than the one you sold. Out of the money. OTM. This option will also be OTM when you enter the trade. Protection. The primary purpose of this leg is to define and limit your maximum potential loss. The difference between the strike prices of your sold and bought calls determines the width of your spread, which directly impacts your maximum loss. A narrower spread generally means lower maximum loss, but also lower maximum profit. Cost. The further out of the money this call is, the cheaper it will be, which increases your net credit and thus your maximum profit. However, choosing a very wide spread increases your maximum loss if the price moves against you. 3. Calculating potential profit and loss, crucial for minimum profit focus. Maximum profit. This is the net credit received when you initiate the trade. Maximum profit. Premium received, sold call. Premium paid, bought call. To maximize this, you want to maximize the premium from the sold call and minimize the premium for the bought call. This often means selling a closer OTM call and buying a slightly further OTM call. Odd. Maximum loss. This is limited and defined, a key advantage of spreads. O. Maximum loss. Higher strike price, lower strike price. Net credit. Received O. To minimize potential loss, choose a narrower spread, i.e., the difference between the two strike prices is smaller. Break-even point. O. Break-even point. Strike price of sold call, net credit. Received O. You want the cryptocurrency's price to stay below this break-even point at expiration to be profitable. 4. Executing the trade. Simultaneous order. Most options brokers in the U.S., for traditional assets, and increasingly for crypto options, allow you to place multi-leg orders as a single transaction. This is highly recommended to ensure you get the desired net credit and avoid legging in, where one leg executes but the other doesn't, leaving you with an unhedged position. Order type. Use a limit order to specify the net credit you want to receive for the spread. Don't use a market order, as you might get a less favorable fill. 5. Monitoring and management. Monitor price action. Keep an eye on the underlying cryptocurrency's price. Time decay, theta. As time passes, the options lose value due to time decay. This works in your favor for a bear call spread, as you are a net seller of premium. Implied volatility, vega. A decrease in implied volatility is generally beneficial, as it reduces the value of both options, particularly your short call, potentially making your spread more profitable. An increase in IV can hurt the trade. Adjustment/exit strategy. O. Take profit early. If the crypto price drops significantly and your spread becomes highly profitable before expiration, you might consider closing the trade early to lock in profits. This avoids gamma risk as expiration approaches. O. Manage losses. If the crypto price rises and approaches your sold strike price, you might consider rolling the spread up and out to higher strike prices and a later expiration, or closing the position to limit losses. Don't let it reach maximum loss if you can avoid it. O. Assignment risk. Be aware that the sold call leg has assignment risk, especially if it goes in the money and expiration is near. If assigned, you would be obligated to sell the underlying crypto at the strike price. Having the long call leg helps mitigate this, as you can exercise it to cover the assignment, but it's important to understand. Example, hypothetical crypto. Let's say Crypto X is trading at a 100. You are moderately bearish and expect it to stay below $100.01. Sell 1 Crypto X. Call option, strike 105. Expiration 1 month. You receive a premium of $300. This means you collect $300 for 1 contract representing 100 units of Crypto X. 2. Buy 1 Crypto X. Call option, strike $110. Expiration 1 month. You pay a premium of $1. This means you pay $100 for 1 contract. Net credit received, maximum profit, $300. $1 equal $200 per unit, or $200 per contract. Maximum loss, $110, $105, $2 $1,000, $2 $300 per unit, or $300 per contract. Break-even point, $105, sold call strike plus $200. Net credit, $107. Outcomes? Crypto X price at expiration is $105 or below. Both options expire worthless. You keep the full $200 net credit. This is your minimum profit, maximum profit for this strategy. Crypto X price at expiration is between $105 and $110, e.g. $107.56. Your sold $105 call is in the money, but your bought $110 call is OTM. You'll lose money on the spread. For example, at 107.50 seasons, The $105 call has an intrinsic value of $2.50. You received $2, so you lose $0.50 per unit. Crypto X price at expiration is $110 or above. See $112. Both options are in the money. The $105 call has an intrinsic value of $7, and the $110 call has an intrinsic value of $2. The spread is worth 5. Since you received $2, your net loss is $3 per unit, $5, $2. This is your maximum loss. Important considerations for crypto options in the U.S. Regulation. The regulatory landscape for crypto options in the U.S. is still evolving. Ensure you are using a regulated platform that offers options trading for the specific cryptocurrencies you are interested in. Liquidity. Crypto options markets can be less liquid than traditional stock options, especially for less popular cryptocurrencies or further OTM strikes. This can affect your ability to get desired fills and exit positions. Volatility. Cryptocurrencies are highly volatile. While this can lead to larger premiums, good for credit spreads, it also means price movements can be swift and significant, increasing the risk of your short strike being breached. Settlement. Understand if the options are cash settled or physically settled, meaning you might have to deliver or receive the actual cryptocurrency. Most crypto options are cash settled. By following these steps and carefully managing your risk, you can effectively use a bear call spread to generate income in a neutral to moderately bearish crypto market, aiming for your minimum profit, which is the maximum credit you receive. Please like, subscribe, and comment.